Thank you. So they're going to present an application then, two papers. The first one is this paper about currency unions and what happens with the law of one price. And then a more recent paper that studies tariff pass-through and what's been happening with consumer and border level prices after the escalation of the trade war that we have seen in the last couple of years. So let me start with the first one. This is a paper where we tried to test if we could measure the LOP, the law of one price, in a large set of goods that were identical and sold by these large global retailers. And as a motivation, clearly there are all these classic theories that says that the law of one price holds, but the big literature had showed that it failed. And understanding what happened to these relative prices mattered, as we have said, for the behavior of real exchange rate shocks. So what we did is, in a way, we expanded the available data at a very micro level, finding identically tradable goods. We were certainly not the first to use identical tradable goods, but it's just the number in number of countries that we could show these statistics was expanded a lot. And we were scraping data much in the same way that you saw me scrape just a few seconds ago. And then we found basically two results. We showed that the LOP holds within currency unions, and it otherwise fails. So the currency in which prices are displayed, swamps, and is far more important than other things we would traditionally think are important for determining the LOP. So whether you're in a similar trade union or you have a nominal exchange rate that is very very volatile. And then the other thing that was interesting, I believe, from this paper was the fact that we created this new decomposition. And since we could see when these goods entered and were sold for the first time, we could try to see if we could capture the adjustment that takes place at the time of a product introduction, which is something price indices tend to miss, because when you're creating a price index and for inflation measurement, what tends to happen is that you just focus on changes of products over time. And if there's a new good that appears, probably won't get included into sample until an older product disappears. And the statistical agency is usually not going to link the price of the old product and the new product. So there were other papers that had speculated about this, and we sort of were able to test it nicely with this one. So let me describe a little bit the data. We used Apple, IKEA, Zara, and H&M, scraped everything they sold for about 4 years, which gave us a lot of information on a daily basis. Things that are important for you to remember in these slides: the prices I'm going to show you include VAT taxes. So if we make them identical, the VAT taxes were actually different between many of the countries within the European zone. So it's amazing that they were making them identical, because they have very valid reasons to argue we have to make them a little bit higher or lower in some locations. We cannot measure pass-through estimates here because we didn't know where the products were actually produced. So we restricted ourselves to LOP and sort of real exchange rate calculations. As I said, this is actually where we started testing if the online and offline prices were generally identical. I would go with my own phone and take pictures of prices in Zara, H&M. I felt very uncomfortable doing that, particularly if walking into some stores and taking these pictures. But we clearly started realizing they were quite identical. And these companies, they sort of sell exactly the same goods everywhere, which was a good thing. So what is the basis of the paper? Just let's calculate a good level real exchange rate. You have basically the price in country I, you have the exchange rate between that country and country J. So we have this very simple expression that Brent already showed you in log terms that measures the good level real exchange rate. And we could just build these simple plots of the good level real exchange rates across countries. Now I am picking here as the base the United States, and then plotting it. For example, if we focus on this histogram, you have all these different products having a different real exchange rate relative to the US, and you can see this wide dispersion as the literature had already shown. Some goods are far more expensive, others are far cheaper, and it sort of happens across the board. Now, when we refocus this in terms of currency unions, and we looked at European countries and used as a base the case of Spain, what we found was very different. So in the US and Spain, there was these big differences, but you take nearly every other European country and all of the mass was very close to zero. So the real exchange rate was, so the prices were identical, the real exchange rate was 1.
Alberto, sorry to
Yes.
jump in, this is Brent, but the x-axes on these histograms somehow look, the axes values don't look to me properly. I don't know if others are having the same.
Yes.
The key thing is to, maybe you can explain where the, the mass in those spiky histograms corresponds to, because it doesn't look like 0 on my screen.
No, you're right. I think this was PowerPoint shifting the scale, but this mass here should be right at 0, which means that the prices expressed in the same currency were actually identical. No? And that's where the mass lies. So we have a collapse in the distribution, and the law of one price holds when we see that mass at 0. Maybe the next graphs, if you look at the paper, it will become more obvious. Now, it's interesting here, we have 3 countries that are actually in Europe, and where we see the histograms are actually not so concentrated. And we included these 3 in particular because, for example, you take Norway. Norway is not part of the EU. You can say, well, this is about tariffs and things like that. But then you look at Sweden and Denmark, and they're both part of the EU. So they have these lower tariffs. That doesn't seem to matter. It just keeps on creating this difference. And in fact, you have Sweden that has its own currency that is quite volatile, but then Denmark has a very hard peg to the euro. So there's no volatility in the nominal exchange rate between the Danish kroner and the euro. And you could think, well, maybe it's a matter of people being able to quickly make a calculation of what is the different price. And in Denmark, that should have been the case, but it isn't. It actually has these differences in LOP. No? So we tested this for various subsets. It's something that happens in all the retailers. We can restrict the data to just look at bilaterals between countries that have currencies that float with each other. We did find that having a peg and reducing the exchange rate volatility had some of an impact, but the vast majority of the impact, as you can see in this shrinking coefficient, comes when you are actually looking inside the currency union. And we found this for European countries, but we also found it for the US and El Salvador or Ecuador that are dollarized countries. You can see in the paper those distributions suddenly shrinking and all the mass being at 0 with the LOP holding, also for dollarized countries, which was quite surprising, I think. And in a way, it sort of showed that the currency in which these retailers had to show their prices mattered a lot more than other things we would traditionally consider more important for the LOP. No? And it was not just about this nominal exchange rate volatility, like I mentioned. Now, by the way, we also showed this in the time series. So we had, while we were collecting data, it happened that Latvia joined the euro. So we could see how the pricing actually changes. And immediately, within a matter of days, the distribution shifts completely and becomes, the LOP starts to hold within these countries. Now, the other thing that, as I mentioned, that we could do is we knew when these products were coming in. And so we wanted to test is maybe some of these deviations that we were seeing in the real exchange rate were happening because, they set the optimal price and the LOP may be held at the beginning, but then the fact that there's price stickiness and differential shocks in each country started to create these differences in real exchange rates at the good level. And we find actually the opposite. We found, we did a decomposition that I'm describing here, where you can take the I is the date at the product at which the product is introduced. L is the date at which the product is last seen on the sample. So you can take the price of each good and split it up between the initial price that was set for that good and all the subsequent changes you can observe of that price over time. And you do this for both countries. You calculate the sort of good level real exchange rate, and you end up with these 3 terms that capture intuitively the 3 ways the real exchange rate could have changed. One is the real exchange rate that they set at the time that they introduced the goods. This first term that I'm going to call the good level, the real exchange rate at the time of introduction. Then there are changes that are coming from these price movements that we may see in each one of these countries. And then there's a third term that's going to be what we call the stickiness term, which is coming from the fact that the real exchange rate is moving around, but maybe prices are not moving around so much. So we could just graph the same histograms and split it up between these three components. And this is what we found. We found that, you know, this is the original ones that I was showing you. I think here yes, the scales are okay. So it takes care of the problem we had before. But then we had the real exchange rate introduction, changes in demands that are coming from price changes, and the stickiness. So the stickiness part did matter, but clearly what seemed to be driving all these differences, what we were observing, was the real exchange rate that were set at the time that we're actually introducing the goods. No? So it started making us think, you know, why is this happening? We looked at the time series as well. We measured this real exchange rate time of introduction, and you're looking at plots here of how this was moving around with the nominal exchange rate. So if there's really no adjustment to the changes in the nominal exchange rate, these two things should move together. And that's what we found. We found that firms were not sort of using the advantage of introducing a new product to pass on, let's say, some of these changes that the nominal exchange rate was producing now. So this had several implications if you put these two results together. One is that I think we added value to the literature about market segmentations and the LOP in particular. This idea that the currency union was swamping things like geography, taxes, culture, and nominal exchange rate rigidity that we would traditionally think is a big part of this. There's to some extent for policymakers, when they introduced the euro, many of them were actually expecting some sort of price convergence, but at the time, since we were in the middle of a crisis and countries that had joined the euro had to adjust to differential shocks, there was a lot of talk about you know, Greece having to do an internal devaluation. It had to reduce its prices to sort of adjust to the shock because it couldn't use the exchange rate to do that. And in a way, our results were speaking precisely to that. If it is the case that, in particular, these global retailers are pricing identically within currency unions, the ability of doing these internal devaluations was becoming quite hard. You can think of this even in the context of pricing within countries, by the way. Part of my work has also shown there's uniformity in pricing of large retailers within countries. So that will make some of these adjustments across regions quite harder. And then I think also, as I mentioned in the first talk, is that the standard measures of real exchange rate may actually omit some critical information by not including these prices and introductions. We did find that these type of retailers do not seem to take advantage of the product introductions to make these changes, but I think there's a lot to be done about other retailers that may behave differently. So worth keeping an eye. And it also finally just suggests there's an important role for these real rigidities and variable markups. It's interesting. I get the sense that many of these global retailers, they're thinking less about the, you know, optimality of pricing on a global scale and more about the prices at which they launch products relative to the previous versions of the same products being launched in those countries. So that creates some persistent real exchange rate differences across countries. Okay, so that's one. How am I doing on time? What time do you want me to end, Brent? Sorry, can you say that again?
I mean, do what you can, but you know, if you're able to end it, you know, in 10, 15 minutes latest, that would be great.
Okay, it's gonna be hard, but I'm gonna try to do it
do what you can. Present your material well.
Okay, very good. So tariff pass-through, the question you all know about the trade war. The one thing I want to say here is that there's been this progressive increase in tax rates. The fight with the China in particular involved several stages of escalation. So there was an increase of 25% in some tariffs that affected mostly intermediate goods in July 2019. And then as the escalation kept on happening, these more and more consumer goods were affected. So we wanted to study how quickly there was a pass-through into consumer prices, and also see and compare this with the exchange rate pass-through, and see if the fact that the trade war was causing a depreciation in the renminbi was sort of softening the blow for US importers that may be facing higher costs. So, but ultimately, what we wanted to do is say who was paying for this. You probably heard, President Trump has said the Chinese are going to pay for this. That could happen, by the way. If you think about the problem here, you impose a tariff at the border, 3 people could bear the burden of the tax. It could be the Chinese exporters that decide to lower the price in US dollars, and that's what the president was probably hoping would happen. Then it could be the US importer that faces this higher cost, or ultimately it could be the consumers that are paying higher prices. Now, to know who really is bearing the incidence of the tax, you really need to observe prices in 2 locations, at the border and at the consumer level. So that's what we did in the paper. We looked at the border prices, at the store prices using the BPP data. And as I said, that is crucial to determine the incidence. We remain largely silent, I should say, on quantities and welfare, but there are other papers that have analyzed that. And what did we find? We basically find that the US, within a year and a half of the trade war, the US is mostly still bearing the majority of the burden of these tariffs, at least in terms of prices. Let me be clear. Why? Well, the Chinese have not reduced their export prices by much in US dollars. The claims that the RMB depreciation was offsetting the impact of the tariffs is not valid in the data, because what happens is that the pass-through into post-tariff import prices has been much faster and in magnitude has much larger than the traditional pass-through from the exchange rate shock that we know from the literature, and we document in the paper as well, is relatively quite low. So this has implications for several literatures. But if you look at the border prices, that's what happens with imports. When we look at export prices, we do find a difference. It turns out US exporters have lowered their prices significantly. And part of the reason for that, the difference seems to have to do with the type of goods that are being sold and how differentiated they really are. It turns out that both in imports and exports, we find that differentiated producers of differentiated goods feel the pressure to adjust the prices at which they sell to the other country, because the other country obviously has alternatives for this. But then you look at the compositions of US imports and exports, and most of the exports that have been receiving these retaliation tariffs are actually undifferentiated. So US exporters have had to lower their prices a lot, while when you look at imports, that does not seem to be the case, particularly in the case of the US-China trade. We bring into the US a lot of differentiated goods here. So the Chinese have not reduced their export prices by much. And then we look at what happened with consumers. We found basically a very uneven pass-through here. Some good categories adjust this, others do not. But we look at various margins of adjustments, and essentially we find that the retailers have ways of absorbing some of the costs through their markups, but also by doing things like front-running or front-loading their inventories. They basically started importing a lot more before the tariffs were put in place, and we can see that in the customs data and the forms that they fill in. And then they also started gradually diverting some of the trade and bringing it from other countries to avoid having to pay the taxes. So I don't have much time to walk you through the results, but I'll just show you a few interesting graphs that make this very clearly. Imports from China and other countries here, you're just looking at prices post the tariff, and you see these big jumps. These are the prices that the importers pay. They line up very clearly with the magnitude also of each of these increases. Everything you see in red here is coming from China. So all these waves were very clear when we look at the imported prices. When we look at export prices, we find that those exports from the US that were affected were actually falling much quicker. And as I said, this has to do with the fact that the exporters were selling things like soybeans to the Chinese, and the Chinese have alternatives from countries like Argentina, Brazil to bring some of these things. We have these pass-through regressions that try to quantify this into greater detail. This is essentially very standard regressions in the literature that have, in addition to having the exchange rate changes, we added the changes in the tax rate at the level of individual goods. Let me move quickly to the final table. You can see that if we looked at imports, prices seem to fall a little bit, but that basically disappears once we control for the exchange rate pass-through. Much of the decline we saw on the import post-tariffs was actually because there was some depreciation in the renminbi. But by the way, this regression is before the actual tax. So you're looking at the price, let's say that the Chinese exporter is selling before the tax actually happens. Now, when we looked at exports, we saw those declines quite clearly. And then if you look at differentiated and undifferentiated goods, like I said, undifferentiated ones was where the pass-through was greater, but it just happens to be that numerically, all the exports, most of the exports in the US are actually undifferentiated. Okay, so there's some back of the envelope calculations. I'm gonna skip all these. I'm gonna show you a little bit what we did at the retail level with the BPP data. We did two things. First, look at case studies of specific goods that we know are coming mostly from China. They're easy to identify and know that they've been affected by tariffs. And then for some goods, we actually could see the country of origin and the HS code classification. So these graphs here show you, just focus for a second on this graph on the right. It's showing you the annual inflation rate of goods like washing machines, handbags, tires. And these are things that you may have heard in the media where we're going to be impacted a lot with the tariffs, mostly because they come from China. And there's some interesting heterogeneity here. Washing machines, which is the blue line, we see this big jump just a few months after the tariffs are put in place. And there are other papers that have looked at this. No? And there's a CPI index that matches up quite nicely with this. So there's been some adjustment in that sector, but that's a type of tariff that applied to many countries. It wasn't specific to the case of China. Now you look at the others, and there's been a gradual adjustment in the price level, but it's even muted for refrigerators and things like that. So there's clearly some heterogeneity, some pass-through in some categories is not as high as we might have thought to consumers. Now, the truth is, these indices that I showed you, we weren't sure how many of those goods were actually coming from China, and there are also different types of refrigerators. So we focused on two large retailers for which we knew the country of origin, and we knew the exact HS code classification of each good. Now, how did we do this? This refers to the data. The country of origin, these were retailers that either showed the information on the website so we could scrape it, or the retailers volunteered to give us the information. So we had the prices from the scraping, and they gave us, one of them gave us the country of origin information for each good. And then the HS codes, what we did is we had the product description. So we basically did what every importer does. You hire a company that classifies the goods for you according to the product description. And in fact, this is publicly available. The Census or Eurostat, they provide these tools, which are basically using machine learning algorithms on the back. And the more people use them, the better they get. But you can basically plug in, let me show you this live. It's gonna make it more interesting. You can go here and say, look, I have let's say a banana, and it will automatically try to classify it. No? Now, many times you actually have to tell it exactly what it is before it gives you the HS code. Sometimes it's much quicker. If I put like LED, TV, Samsung, it will automatically give me the code. Okay?
I don't think we see the screen that you're working on.
Oh, okay, okay. What are you seeing? Let's see. Okay, stop share. I'm sorry. All right, thank you, Chensi. So I was showing you this website from the Census Bureau. It allows importers to realize what is the HS code they should declare. It's using the technology of a company called 3CE Online, as I was saying. So if I put Samsung TV and I classify it, I get the code. By the way, you can scrape this by supplying the product description, and you can scrape the code. We actually, since we have so much data, we actually hired the company to do this for us. But I also relied a lot on arrays for when we had a good that we couldn't classify automatically. Someone had to come in and say, well, you know, this is actually a fresh banana and a type of plantain, and that's how you get the HS code. So basically, that's what we did. We let me go back to my slides. We got all these individual products. We classified them So we knew the country they were coming from and whether they were actually impacted according to the product description by the tariff or not. And this is the result you get with these two countries. You see the goods that are coming from China in red, and those that are affected or not affected by the tariffs, and then in blue all the other countries. There's clearly something going on here where the prices of every single good starts to increase gradually, but there's basically no difference between goods that are affected and not affected by the tariffs over time. So we did the pass-through regressions, and just a back of the envelope calculation here for a 20% import tariff. We basically estimated that there was a retail price increase of 0.7% in the full database. We did subsamples that we thought had better data or less possibility of having a measurement error, and the best we could get to was 3.2%. So if you sort of make a quick calculation, let's assume there's a distribution or local component cost of 50% for the 20% tariff that we see is mostly borne by the importer, then around 18% of that is what the importer pays in addition. Then if it's 50%, we should have seen about 9% pass-through if they really pass it on into consumers. But there was very little evidence coming from this data that the retailers had decided to pass this on. It could be the retailers or the wholesalers. One thing that could happen is they were spreading the cost across goods. And then we did a comparison between Canada and the US, because the Canadian, these companies also sell in Canada, where they do not face these additional costs. And we saw prices creeping in general in the US, but the same thing happened in Canada. So it suggests that they were in fact absorbing some of these costs through their markups. And this is finally an element with this. We looked at other ways they could be adjusting. And for this, we went to customs data. There are several companies providing this information that you can sort of purchase. You can see what these large retailers were actually importing, because every time they import directly, they have to declare in a bill of lading where the goods are coming from and other things. So we basically just track for these two retailers the metric tons of goods that they were importing over time. And this first dashed line that you see here towards the middle of 2017 was the time when it started to become obvious that a trade war was coming, and we see these imports from China actually starting to pick up, and then things quiet down a little bit until the tariffs are imposed, and then we see again some of these spikes. So this is all the front loading that was happening. Now, once the tariffs are in place, this goes away, and that's why you see these numbers coming back down. The other thing interesting here was this red line. This is imports from other countries. So this is trade diversion, trying to avoid the tariffs. And we see it sort of going up significantly during 2019 and spiking actually at the time where there was an escalation towards the end of 2019. We've spoken to many of these retailers. They tell us they're doing the trade diversion that is easier for them in the short run. But making bigger investments of trade diversion would require many of them to be convinced that the trade war is something that is here to stay. So we'll see what happens. But let me just finish with that. We think our results are basically showing all these frictions that have impacted clearly the importers. They ended up paying most of it. And much of that has not been passed on to consumers. So it's a short-term kind of story. Over time, I think as time goes by and it becomes more obvious that the trade war is going to be permanent, these retailers are facing and importers are facing this pressure to pass on some of these higher costs to the Chinese exporters. They're going to be more likely to do so, I believe, because there's more opportunities to do trade diversion. And then they're also going to try to push that gradually towards consumers as well. There's less of an opportunity to do front loading, and their profits could be affected for a while. So we may see quite a different type of evolution. But in the short run, it's mostly the importers and the US firms that have bear the cost of this. So we gave you two exercises here that you can use our data to test some of these things. The first one is in this paper about tariff pass-through. We ask you to modify the replication code to show that Chinese and non-Chinese goods have similar price trends after the tariffs. We gave you some solution graphs that you can look at, and all the data that I've been describing, even if you wanted to test, for example, pass-through from a particular country of origin and things like that, you can do it because the data is available online. The second one goes back to the law of one price example. We ask you to replicate a figure there. It's tricky here because you have to use an exchange rate with respect to Spain. So that's probably the hardest thing to get right. But and I'm hoping many of you will sort of scrape some data from one of these global retailers and see the results that we presented still hold. There are many reasons to think things could change. It's been many years of a European crisis. So maybe eventually they start to differentiate their pricing strategies in Greece versus France and other places. All right, so I'm going to finish with that. I'm going to thank you and then happy to take any questions.
Let's end the